President Trump has done something no other president in history has ever done. Is this a sign that the U.S. economy has reached its breaking point? Stay tuned. I'll show you why this has me so concerned, because it's everything to do with what happened on Friday. Let's take a look, because we got the biggest job revision since 2020, and what it did is it exposed the pitfalls not of the U.S. economy, but of the economic data. Because revisions of this magnitude, well, they're extremely rare. The problem is they're more likely to happen going forward. I'm going to show you why. The Bureau of Labor Statistics marked down non-farm payrolls by nearly 260,000 in May and June combined. And the 2-month revision was due in part to seasonal adjustment issues, but also what economists say is a broader trend of low response rates. And this is a major problem with these reports, because we've been seeing this, particularly in the JOLT survey. The results of it are somewhere around 30%. And this is a major problem, because if you need accurate data, you need companies to respond. The challenge is they're not responding, and when they do, it's so delayed, we get massive outsized revisions. In a social media post on Friday, Trump said he directed his team to fire Erica McEntrefer, who was appointed by Joe Biden, quote, immediately. He went on to say that important numbers like the non-farm payroll report must be fair and accurate, and no way can they be manipulated for political purposes. And that's exactly what he thought this was all about, because the numbers were, again, revised down by 260,000, which is a substantial drop, suggesting that his economy isn't working. But is it really about the economy, or is it all about the data? Well, the evidence shows it is about the data. And yes, the BLS did affirm that she was terminated on Friday. Trump later posted that he believes the numbers were, quote, rigged to make Republicans and him look bad. He took it as an opportunity to once again criticize Federal Reserve Chair Jerome Powell, who Trump has berated repeatedly for not lowering interest rates. And this is one of the biggest concerns I have, is because when you have bad data, you get bad policy, and that's exactly what's happening right now. But something that isn't rigged is the returns our subscribers are getting. Let's talk about our CTA Timer Pro, Momentum Timer Pro subscribers. We told them to buy on the open ZROZ back on July 30th. That trade now up 2.07%. And where did it come from? It came from our Metre strategy. Now, if you haven't heard about this, there's a link in the description below. Stay tuned to the end of the show, because right now we're throwing this for free. No matter which subscription you have, grab those links in the description below, get your coupon code for the free 30-day trial, and start trading. Our Metre strategy is changing the game in the way people trade, because much of the downshift was seen in state and local government education, which substantially boosted June employment, only to be largely revised away a month later. In emailed comments to Bloomberg, the Bureau of Labor Statistics said those sectors made up about 40% of the revision, and was, quote, largely a result of routine incorporation of additional or corrected samples that came in after the initial release. Now, what I want you to understand is when the BLS collects data for a non-farm payroll report, they don't have all of the data, because everybody isn't responding in time. So part of the reason you see revisions is because they get data in that may have actually mattered for the month before, or even the prior month to that. And as they get incorporated, you can see revisions both to the upside and the downside. So what the BLS is saying here is, look, we had bad data. We didn't have enough data. Now, if you're wondering why it seems like the payroll report's getting worse over the years, well, there's very good reasons why. Let's take a look, because BLS surveys firms in the payroll survey over the course of 3 months, gaining a more complete picture as more businesses respond. So again, it's just a matter of the fact that businesses aren't responding in time. But there is something that changed in a major way, because the BLS used to have regional offices throughout the country, and those workers, well, it was their job in part to get the responses in on time. And that's one of the reasons we did see the accuracy level was higher, because due to budget cuts, this is now all centralized in Washington, D.C. A lot of businesses just aren't responding, and when they do, well, it leads to big revisions. But a smaller share of firms are responding to the first poll. In fact, initial collection rates have repeatedly slid below 60% in recent months, down from roughly 70% or more that was the norm before the pandemic. And so you talk about bad data, and look at it from an investor perspective. Remember when we first saw those two payroll reports? All the other data that I look at in terms of the regional Fed surveys, the continued claims data, suggested that those numbers were outliers. But what happened? The stock market surged higher. And what did we see the Fed do? Well, they said policy based on it. So one of the challenges here, this is what really has me concerned. I don't think it's politically motivated. I think the issue is if you have bad data, you have bad policy. And the problem is we find out that the data is bad often months after it actually is published. We're seeing these cuts to funding for government agencies affect their ability to collect and analyze economic data. And for all the reports that the BLS is conducting, there's likely to be more volatility going forward. And I want you to see the risk here. This is really my concern, is because let's say the U.S. economy falls into recession. The problem is the non-farm payroll report might not actually show it until 3 months later if it has massive revisions to the downside. And then you think about the Fed, who sets policy based on the economic data. Well, now you have a challenge here because the Fed is data dependent. But the issue is the data is bad, and it all comes down to the collection. That's the aspect here that we should focus on, is that BLS doesn't have the means to collect accurate data and get it out in a timely fashion. So again, I don't think that's anything to do with a rigged report. I think it has everything to do with the fact that the BLS has faced too many cuts. And earlier this week, the BLS had about 15% of its sample in the Consumer Price Index. This is a marquee report on inflation, was suspended from collection on average. And that was on top of an announcement in June that the agency suspended collection in 3 metro areas, which is said happens when its current resources can't support gathering data. So again, everybody's looking to the Fed and saying, look, the data suggests the economy is slowing down. The problem is the government cannot collect accurate data to give to the Fed to set monetary policy. So I want you to see the risk here is we could see inflation rise when it may not be. We could see payrolls rise as we did when they didn't actually rise hardly at all. And again, this all backfeeds all through the government agencies right to the heart of the Fed. And this is a challenge here because the Fed needs real data to support their decisions. And the problem is they don't have it, meaning we could be deep into a recession and have all of the wrong data. You can see why I'm so concerned here. And it certainly does look like if the Fed had these numbers, especially the big revisions lower that we had to the June and May data before the meeting on Wednesday, well, they would have likely been cutting. And I completely agree with that. Now, in actuality, the Fed does get a preview of the data here. The problem is they can't come out and admit that they know it. They can't tell the markets on Wednesday that, look, hey, we're cutting because we see some major issues to the labor market which aren't supported in the data. Because if they said that, and then on Friday, the non-farm payroll report got revised down like it did, the market would then start discounting the non-farm payroll report and start looking to the Fed ahead of everything. And that's the issue here. The Fed has to work with public knowledge. And the problem is the knowledge that we have of our economy isn't accurate. But let's talk about how the non-farm payroll report drives Fed decisions and why having accurate data is so important. Let's take a look at the total non-farm payroll that's shown in change of thousands in persons. It gets the federal funds rate in red. And let's zoom into the dot-com bubble. What do we see? The payroll report dropped down near the zero bar, started to rebound. That got the Fed to cut a little bit. And then as it rolled over and headed lower, the Fed cut aggressively. The same thing happened during the global financial crisis. You can see the non-farm payroll report dropped. The Fed decided to cut. It rebounded. The Fed says, look, we're going to keep cutting. And then as it fell apart, the Fed aggressively dropped rates. But if you, again, think about where we're at now, that could be happening today, and the Fed won't actually have the right data to set policy. But there's something else I want you to see here. This policy doesn't actually work. That's the problem. And where are we at today? Well, because I had to cut off the pandemic data because it skews the chart, you can see right now that the change in thousands of persons is just hovering over the zero bar. But the problem is the Fed's still worried about inflation. They're not seeing pains in the labor market. And we're going to show you what the Fed had to say about this after their meeting. After the release of the numbers on Friday morning, investors boosted the odds of a September rate cut to almost 90%. That was around from 40% the day before, according to interest rate futures contracts. And what Wall Street is telling the Fed very clearly here is you're behind the curve. You need to cut. And of course, Wall Street knows that the Fed did not have that report at the time of their meeting. And what they're signaling right now is if things continue to go down the trajectory they are in September, you're not just going to see a quarter basis point cut. Odds are increasing that you're going to see a 50 basis point cut. But keep in mind, the FOMC has to support their decision. And sure enough, the Fed speakers came out in droves. I'm not surprised that the labor market is slowing. Just from Minneapolis Fed President Neil Kashkari, the data was worse than I expected. But when tariffs go up, you expect prices to go up and the economy to slow. And we're seeing both of those effects. And what Neil is saying is exactly what we're seeing in the economy. We've heard this from Chipotle and Starbucks and a lot of other companies. If we raise prices, spending goes down, foot traffic drops, consumers cannot afford higher prices. But this is exactly what the Fed wants. They want inflation to come down. They want demand to go down. The problem is, the big risk here is if you drive demand down enough, well, the demand for labor goes right along with it. And the evidence of that is clear. Let's take a look at the consumer price index. That's shown on blue on a year-over-year rate of change against continued unemployment claims in red. And we can see very clear instances. Again, let's go back to the dot-com bubble. We can see prices went up just as they are now. And what happened? At first, it didn't impact the labor market. And the next thing you know, what happened? Companies got squeezed at the margin, demand dropped, and alongside it, demand for labor. We see it happen again during the global financial crisis. Inflation took off, then it came crashing down. At the same time, demand for labor went right along with it. And where are we at now? Well, inflation is continuing to cool off. The problem is continued claims are slowly ticking higher here. So again, we talk about companies being squeezed at the margin. Their profits are likely headed negative. For a lot of small business, they're probably already there. They're running out of cash. And when that happens, you go into survival mode. And when you do that, well, you start cutting employees. But again, the Fed's got to justify their decision here. In fact, Atlanta Fed President Raphael Bostic said the numbers today in the revisions, well, in an important way, suggest maybe the economy and the labor market is weakening more broadly. Well, you got this right, Bostic. It is going down more broadly. That's the problem. That's what Wall Street's trying to say here. That's what those downward revisions in the payroll report indicated. That is the problem here. It's not just one sector. It's starting to become a broad-based decline. And again, it has everything to do with the fact that consumers can't afford higher prices. They're not seeing the wage growth. They're not getting the hours. And again, it all comes back to a lack of demand. Let's take a look at real retail sales as shown in blue against continued claims still shown in red. And you can see very clearly that when retail sales drop, the demand for labor goes right along with it. And again, this happens throughout each and every cycle. The risk of this cycle is continued claims have been rising. They're ticking higher. In fact, about 25% of the workforce, according to the Bureau of Labor Statistics, has been stuck on unemployment for over 27 months, and their spending power declines by the day. And again, all this is doing is putting a drag on real retail sales at the time that most retailers have massive amounts of inventory they need to move, and they can't. Again, talk about survival mode. It's firing employees. And again, as I said, if inventories don't move, well, then manufacturers don't need to produce, and we see the same effects. Let's take a look at manufacturers' new orders of durable goods shown in blue on a year-over-year rate of change against continued claims in red. And again, as retail sales go down, well, factory new orders drop, and so too does the demand for employees. Again, you look at this throughout every single cycle, and that's the risk here, is again, we saw all this demand, but it didn't lead to hiring because a lot of manufacturers already knew ahead of time that this wasn't going to last. And now you're going to see in the months to come, the layoffs are likely to increase here. Remember, Challenger Gray and Christmas said that high-end corporate layoffs, we're talking that you have to put out notices. That was over 60,000, and seasonally very unusual here that we would see that at this time of the year. That's the risk we're facing in this economy, is more companies are going to lay off. And asked if he would have supported a different move earlier this week, Bostic said, with a jobs report on hand, I don't think so. Added in many ways that the labor market still looks good. So I want you to see they're still justifying their position here. And there is an argument to it. They could say, look, retail sales did go up. And in fact, people didn't get hired because there was trade war uncertainty. You're going to watch, they're going to say that. That's my prediction. They're going to say this had everything to do with the trade war. And once that goes away, you're going to see employers hire. But the issue is the economy is continuing to slow here. And I don't think cutting rates would make any difference, but it might give consumers some sort of hope that the government's doing everything it can. In fact, Cleveland Fed President Beth Hammack jumped in on this too, saying that the labor market still looked healthy. although it was disappointing report to be sure. Well, that was an understatement. It wasn't a disappointing report. It was an unheard of decline to the downside. We don't get 260,000 worth of revisions cut off payroll reports over a 2-month period. That just doesn't happen. And what it's telling us is, once again, we have bad data, we make bad policy, and now you're seeing it in real time that this bad policy could accelerate the U.S. economy to the downside. Again, you want to see why I'm so concerned? It should be obvious. Because the Fed announced on Friday that Kugler will step down from her position on the board, handing Trump now an opportunity to install a policymaker who aligns with his demands for lower interest rates. Now, keep in mind here, one thing that's very interesting is many people think there's consensus among the board in terms that there's influence, that if you have so many people voting one way, that that's the direction of policy. It's not actually the case at all. The Fed chair gets what the Fed chair wants. Think of the board as more like advisors. He takes in their views into account and then makes the final decision. They vote, but everybody knows you got to vote most of the time right along with the Fed chief. Because if Trump knows who he wants to nominate as a chair of the board, there's no reason not to act now. Well, there is a reason not to act now, is because if you install someone that everybody perceives is going to be the next Fed chief, you're going to have what's called a shadow Fed chair. And now all of a sudden, the market's going to listen to what the shadow person is saying instead of what the Fed chief is saying. And this is going to be a major problem because right now investors are very overloaded into U.S. equities. They need to see everything pushing in their direction. If there's a lot of infighting going on in the Fed or a lot of disagreements, it would create uncertainty. Wall Street hates that. But it's not an action-forcing event. The board has functioned with fewer than 7 members before, and the administration doesn't seem to mind understaffing essential positions. And this is absolutely correct. Don't expect to hear anything from the Fed about this. It's going to be business as usual, even though she's not there. Will Trump step in and appoint somebody? Well, that's the question. And Trump told reporters on Friday he's, quote, very happy to have an open spot on the Fed board that he believed Kugler decided to step down because she, quote, disagreed with Powell on rate-setting policy. Well, there's no evidence to support that. She largely votes right in line with the Fed chief, as most of the members of the board do. The question is, will he install someone or nominate someone that is perceived to be the heir to the throne now? And will that throw off everything that the Fed's going to do throughout the rest of the year? Well, Treasury Secretary Scott Bassent says we're putting together a good list of candidates, referring to the Fed chief, and I would expect that we'd have an announcement by the end of the year, suggesting that he knows that you don't want to disrupt the markets here, and the risk is because if you do, you then bring the markets down at a time the economy is decelerating. It'll drop down spending even more. He knows. Treasury Secretary Bassent already knows that most of spending come from the wealthier consumers. If the market goes down, their spending is going to go right alongside with it. But does the federal funds rate make a difference? Well, the answer is no. And so take a look at this chart of the federal funds rate against continued claims. And what do you see? As claims go up in red, the Fed cuts, and it doesn't stop the trajectory, at least not till the Fed at least has cut a massive amount. Or you could simply say it doesn't work at all because the last 2 cuts didn't change anything. And that's the risk here. This is what concerns me. If Fed rate cuts did work, because we have bad data, we get bad policy, and now we're going to get bad policy with a massive lag. But something you can get in real time, and that is our Metre strategy. Again, this is now available to all of our subscribers. Right now, we're working on building an optimization engine, but let me show you what you could jump in. And again, any report you want to sign up for, you're going to get these trades. And the Metre strategy is an advanced trading system that combines all 9 professional trading strategies into a single intelligent signal generator. It provides 31 more frequent buy signals than individual strategies on their own, while maintaining high quality through multi-strategy consensus. On the trend following side, we have built in the Bravo 9, the turtle trading, a 200-day moving average cross, the golden cross strategy, and the trend pullback. For momentum reversal, we use the RSI divergence and a 520 EMA cross. And for breakout and support, we look at channel trading and Fibonacci retracement. Our target hold period for a swing trade, 2 to 15 days. We have 155 plus signals per year that this thing is generating, and the success rate is unheard of at 55%. Most of these strategies on their own never even generate a 50% win rate, but put them together in the right combination and you get some amazing trades. And right now, again, you can get those too. Grab those links in the description below. Use a coupon code for your free 30-day trial. And with that, I'm Steve Van Meter. Thanks for watching. Thanks for being fans. Bye now.